Accounting equation and Excel. Record receipt of inventory with a bill created from a purchase order, otherwise known as a PO form. Get ready and some coffee because we're going to learn the accounting foundation, the accounting equation using Excel. First, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our crunching numbers is my cardio product line. Now, I'm not saying that subscribing to this channel, crunching numbers with us, will make you thin, fit, and healthy or anything. However, it does seem like it worked for her. Just saying. So, subscribe, hit the bell thing, and buy some merchandise so you can make the world a better place by sharing your accounting instruction exercise routine. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, 4 tabs down below. Example, month 1, practice, month 2, example, in essence, the answer key. Month 1, the prior month of operations that we've done in prior presentations. The practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The month 2 tab, the current month that we're working in, where we started with a blank worksheet but are basically working within a template at this time. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to the example tab to get an idea of what we will be doing this time. Remembering we're building our bookkeeping accounting system basically with the accounting equation acting as our trial balance from which we will construct our financial statement reports, that being the balance sheet, the income statement, the statement of equity, the income statement, by the way, sometimes being called the profit and loss statement. So now we're going to purchase more inventory as the next transaction that we are taking a look at. And there's a couple different scenarios that I want to put in our mind as we think about the purchase of inventory, because it will be dependent upon the type of industry that we are in. In other words, you might be in an industry that buys inventory or one that doesn't buy inventory. If you're in a service industry, then of course you don't have to deal with inventory. However, if you deal with inventory, it's still not all the same, of course. There's a wide variety of different inventory treatments depending on the inventory we are in and possibly the size of the company, as well as maybe the accounting system that you have chosen within it. So we could have the manufacturing of inventory. That would be some kind of process or job cost system where we have to deal with raw materials, work in process, finished goods. That's not what we're going to focus in on here. That's another specialty in and of itself, adding a degree of complexity for the processing of the inventory. But we're going to imagine here that we're buying inventory, marking it up, and then selling the inventory. Even that could have a lot of variations, of course, because you might be buying high-end items that are unique in essence, like cars or vehicles or something like that, in which case you would use like a specific identification tracking each unit of inventory carefully, considering the cost of it and the uniqueness of each item. Or what we're thinking about here is we have different units of inventory, but they're all the same within that unit of inventory, in which case we're not going to specifically identify each unit of inventory, but rather we're going to use a flow assumption, like a first in, first out, or a weighted average type of flow assumption. Now, even there, you could have different components or ways that you track that. One being, you track it on a perpetual inventory system within the accounting system, or you track it externally or possibly in another software like in Excel or in your website like a Shopify store or the Amazon store or something like that. And then you periodically adjust your QuickBooks or your bookkeeping system, your Xero, whatever you're using, to have the financial statements correct for financial reporting purposes on a periodic basis. Now, the next thing we got to think about is when I buy inventory. If we think about buying inventory as an individual, when I buy groceries like online, or well, if I buy whatever online, if I was to buy groceries online and order it online, then I'm going to pay for it before I get the goods. And therefore, they're basically kind of like mine because I've already paid for them, even though they have not yet been shipped. And there will be a financial transaction because I've already paid for them at that point in time. But in some cases, when you're buying inventory, the purchaser has some power. So if you were to buy 20, or 1,000 cups from China or something like that they're going to manufacture over there, they're going to ship them over here, you might be able to be in a situation where you can request the cups, get them, be able to look at the cups, see if they are in accordance with the agreement, and then pay them. So that's a little bit different. And in that case, you would have a request form. That would be a purchase order form. So we would say, please give me these, in our case, guitars. Once I receive them, I'll double check that they are in accordance with our request. I would expect the bill to be in the box of guitars, the inventory that we have received. And then I will either pay that physical bill with a check form or an electronic payment, or I will enter it into my system as a bill and pay it through the accounts payable. So that's going to be the idea that we have here. So in our accounting system, there's no transaction for a purchase order because we didn't actually receive the goods and we haven't yet paid for them. We've just made a request. So in accounting systems like a QuickBooks, you would have to basically enter the purchase order, send it out, and it wouldn't have a transaction related to it, but we would still be able to link the form. So I'd still be able to possibly run a report of the open purchase orders that have not been fulfilled. And then when I receive the purchase order, I want to link it to either the payment form that I get when I get the purchase order. It's going to come with the bill, the physical bill, which I can pay in QuickBooks with a check form instead of entering a bill, or I could put it in our system as a bill, increasing accounts payable and increasing the assets of inventory at that time. All right, so that means that from a financial transaction, we can imagine that we entered a purchase order, but there's not actually a transaction related to it. So within the accounting system, maybe I should have put another subledger that just tracks open purchase orders is probably but I'm just going to record the financial transaction. So I'm going to imagine the purchase order happened and then they shipped us the guitars, and now we have the guitars. They had a physical bill in the box of guitars. We're going to take that physical bill and use it to record the transaction, which within QuickBooks, you can possibly take the purchase order and just say, make a bill from the purchase order, right? And it'll copy over the information that we did to request the inventory to the bill, which we would actually record a transaction for, which we will do in an accounting format here. So a accounting equation format. So we're going to have the purchase of inventory on account. So remember, the terminology on account means I'm not paying cash for it, meaning I'm not going to, I've got the box of guitars, but I'm not going to just pay for them right now. I'm going to take the invoice or the bill, whatever you want to call it, in normal terms language, but I'm not going to enter it into my system. I'm not going to pay it right away, in which case I would have a check form, not a physical check necessarily, but the form used to decrease the checking account could be called an expense form in QuickBooks, or a check form, even if it was electronic transfer. Or I can put it in the system, as we will do here, as a bill form, meaning the bill form specifically means that we're going to increase the liability of accounts payable and then pay it at a later point in time. It's an accrual type of form because accounts payable is an accrual type of account. So we're going to say, all right, because we haven't yet paid for it. So let's say that we're going to have 20 of these SQ guitars. That's going to be the inventory unit that we have. So let's first think about that in terms of our subledger. So I don't think we have purchased the SQs yet. So let's go ahead and we're going to have to add them. So we can imagine like a customer came in, they said, I want the Squire type of guitar. We're like, we don't usually deal with Squire. We've been dealing with Epiphone and Gibson, but maybe we can request the Squire. And then we did a purchase order, possibly putting the customer on the purchase order, even though the vendor doesn't need that information, the purchase order not actually recording a transaction. Then we've got these guitars, which maybe we know who they're for now, because maybe a specific customer requested them. We would enter them into the system, in this case, as a bill recording the inventory, and possibly on that bill, put the customer, which again, we don't need for the transaction of the bill, but that might help us to turn around then and create an invoice, meaning we might make the bill billable so that we can turn around and make an invoice from it. So connecting the forms is the added level of connectivity that you can have in a database program over the double entry accounting system we are doing here with the accounting equation. Let's go all the way up and to the right to our inventory. So here we are. We're on the inventory. We want the SQ over here. So this is the SQ. We're going to put the date on 2/22, and let's, oh man, the date's messed up. Let's copy the date field up here. So I think we can copy, let's copy one of the date fields that I know works and just say format paint that down here. And so, okay, so this is going to be on 1/20, I think it is. And we're going to say that we purchased 20 units, and we're going to say the cost of these units are $168. So now we went to the vendor and said, how much do these units cost? $168 each. So we're going to say 20 units times 168 is going to give us the 3,000. I'm in the wrong column here. It should be over here. 20 times 168 is 20 times 168. Let me delete these. That's the wrong spot. So the ending inventory then is simply going to be 20 times 168 is going to be this times this. And then I'm going to copy that down so it gets into this cell down here, because that's the one that's going to be pulled into our check account for the total of all the subledgers. So I'll copy that equals the one above it. I'll copy that down. And then I want to make this bottom one the fancy green. So just to indicate to myself that that's the one that's being pulled over to the general ledger. So now we're going to say, okay, let's do the journal entry now, knowing that the cost of these now is $168, not the sales price. We don't know what the sales price is because we're not tracking that in our subledger, although in a QuickBooks report, it would probably give you both the sales price and the cost. But remember, we're putting it on the books at cost, not the sales price, because that's what we actually paid for it. So let's go all the way to the left again and back down, and we'll record this thingy. So now we're just going to say inventory is going to be going up. This is going to be equal to the 20. And then I'm going to say times, and then I'm going to go all the way up to my subledger to pick that cost up again with a formula. So I'm going to go up to the top, all the way to the right to that new bit that we added, which is way over here, the SQ. So I'm just going to pick up that cost of 168, which should give me a total of the 3360. So inventory is going to go up in dollars of the 3360. The other side, we're not paying for it yet. We could have just written a check for it, but we're not doing that yet. Instead, we're going to be increasing the accounts payable, entering, we imagine, a bill form then. So this is going to be the liability is going to go up of accounts payable. Now we also are going to need the subledger here because, so let me put the zeros across the board. Zeros across the board. All right. And we'll put the zeros in. Okay, and now we've increased accounts payable. Therefore, we're going to need a subledger over here tracking not by date, not by inventory unit, but by vendor who we owe the money to. So I'm going to select the column AY up top because I want a new column, which is going to be the tracking of each of the vendors. Right click and insert. And the new one I think is Squire, which I might spell wrong, Squire, something like that. And so if I spelled it wrong, I apologize. But then we're going to go down to this last transaction. That's why the zeros help. There's the end right there. And I'm going to say this equals then all the way over the, let's just say equals the one in accounts payable, 3360. And now I'm going to go up to my balance up top, and I'm just going to do the running balance all the way down. Equals the one above it plus the sum of the two vendors. This is my running balance. I'll just copy that down till something happens. And so now my subledger here is at 3360, which of course should tie out to what is in my general ledger account. And that looks good. Okay. So let's bring down the balance then. We'll bring down the balance. Let's copy this down to make sure we're still in balance first. I could do this by going all the way across and copy this down. And so that looks good. So we're still in balance here. So that makes sense. Okay, let's put an underline all the way across this way. Put an underline, home tab, font group underline. And then I'll get rid of the underline on these two. Here, holding down control, and here, un-underline. And then we will sum it up. Equals the SUM of the prior balance and the current activity. I'm going to copy that, right click and copy and paste that, just the formulas all the way across here. Right click, paste just the formulas. And then I'll copy down here to bring that down. And then I'll copy down here to bring that down. And that looks good. Let's copy down our ending balance. I'm going to go all the way across, copy this down. So we're still in balance here. Underline, assets went up by the 3360. Liabilities went up by the 3360. Here are our new balances. One other thing to check on our subledger here is going to be this 9626. Now I just want to point out here that if you used a software like a Xero or a QuickBooks, the accounts payable would populate the subledger automatically. In fact, it won't let you typically record something to accounts payable without a vendor because it won't let you mess up the subledger. You could still do it if you really tried, but typically you can't do it. You can't mess it up. Now, there's pros and cons to that. Higher up software or more customized software for larger businesses actually gives you more capacity to mess up the subledgers oftentimes, unless you actually put in yourself the internal control of not doing that, because sometimes you might want to post something to the subledger. So it depends on the software you are using, but we have to tie that out to the subledger. And here we're doing it manually, right? If the inventory, however, does not force the subledger of inventory to match on pretty much any software that I know of the inventory account, unless you were to customize the software to do that, because QuickBooks or Xero can't really do that because you might not be using the subledger to track the inventory per se. So in other words, you might be using a periodic inventory system. So even if you have a perpetual inventory system, it might record this automatically. So in other words, if I populated this properly, the bill would populate the subledger properly, and I wouldn't have to do two separate maneuvers like I'm doing here to do that. But if you did it improperly, then it is, and you posted something to the subledger without recording to the general ledger account of inventory, that's possible to do, to have the subledger out of whack, right, on the inventory side. So just to keep that in mind. So we're going to go ahead and double check this one up here. So let's go to the inventory. I need to re-up. So there's the 9626. I'm just going to double fix my check figure. deleting this in bit, and I'm gonna put my cursor back down and say minus the inventory account of this one, which is our last balance. And that, oh, wait a sec, 9626 que paso. Over here, I'm at 9626. I think I picked up the wrong one. Let me do it again. So let me do it again. I think I just picked up the wrong one. Am I dyslexic here? It looks like 9626, 9262. I think I'm 9626. Let's see if I can get it right here. Get it right, man. 9626, right there. 9626. Boom. There, that's so now it's back in balance. So that ties out to our subledger. That looks good. So if I go back on over, so when we purchase the inventory, notice that the income statement isn't affected. Even if we paid cash, it wouldn't be affected, even though the inventory is on the books. Why? Because we put the inventory on the books as an asset. When will it hit the income statement? When we expense it in the form of cost of goods sold. That means when we sell the inventory so that we can match up the proper period would be the idea there. So that's going to be that. Therefore, there's no impact on the income statement, and the income statement is still revenue minus expenses is 516. And here's the old, I'm holding down control, old revenue and expenses from last month, meaning the 2 months combined are still at total net income of 7944 is the general idea. All right, I think that's it.